Morning, everybody. Thanks for joining us this morning for our final webinar of 2022. And we're going to be looking forward into 2023 across all areas of financial planning. I'm joined by my colleague, Robert Smith, who you'll be hearing from also. So just to start off, Robert is firstly going to speak about the investment market outlook for 2023. I will then discuss financial protection. We actually had this section originally at the end of the agenda, but I wanted to bring it up as a second item just because it's very important in these current volatile times to discuss what financial protection is and what actions you can take to mitigate any risks. We'll then look at portfolio management in the context of the risks from section 2, but also the market outlook from section 1. And finally, what's very relevant at the moment is cash flow planning. This is because we're living in a high inflation world where the cost of everything is going up. And we discuss some tips on cash flow planning, both from an income and an outgoings perspective. It's important to note that we've lots of different people on the webinar this morning. We've got some professional referrers, accountants, tax advisors. We have some individuals and families, and everybody is different. And that's what's the thing is about financial planning, is that everybody's own financial circumstances and their goals and objectives differ from everybody else. So not all aspects of today's presentation will be relevant to you, but hopefully a good portion will be. Do ask questions as we go. There is a Q&A button within Zoom. If you ask a question to Robert and myself, we'll endeavour to answer the question throughout the presentation. Nobody else on this webinar will see your question other than myself and Robert. And if we don't get to answer it during the presentation, we'll hopefully answer it at the end. So before we go into the economic and market update, I just want to discuss 8 different pillars of holistic wealth management, 8 headings that are important in isolation, but are completely interdependent on the other 7 pillars. So the first is retirement planning. So some people are saving towards retirement or are on the way to retirement. Other people are already in retirement. Asset allocation is important for everybody, and that's just how your overall assets are split between the different asset classes. At all times, you want to make sure that in your life, in your assets, in your pensions and everything, that the portfolio is made up as cost efficiently and tax efficiently as possible for you. Risk management is an area we're going to speak about today. That's just looking at the downside risk. Remember, when everything is rosy and everything is positive in the economic world, probably similar to what we've seen over the last 10 years, up to last year, or probably up to the onset of COVID, we were in a really pleasant environment because we had all-time low interest rates, we had rising asset prices and full employment and things like that. But now we're facing challenges. So look at risks is very important and how to mitigate those risks. Education is very important, that for anybody who has assets or has significant income, or any family should always understand their finances. And we see one of our roles at Compass Private Wealth to educate our clients. We obviously manage assets and set up assets and policies and accounts, but we also feel it's important for you to be as educated as possible with your own finances, or if you're an accountant, a tax advisor, solicitor, when you're speaking to your clients. Within the asset allocation sphere, selecting investments is also very important, because you can have the perfect asset allocation design built, but actually if your investments are poorly selected, or you're in assets that are too risky, or investments that aren't transparent, or whatever it might be, it undoes everything, because the wrong investments could have catastrophic impacts for you. Cash flow planning is extremely important at all times. So we're going to speak about that today. And finally, succession planning. Succession planning is what happens to your assets after your demise. If you're married, after the demise of your spouse also, what have you done to transition assets onto the next generation? Some people don't feel that feel that maybe their children are financially independent already, so they want to spend all their money in their lifetime. That's absolutely fine. Either way, it's important to have a succession plan in place. Now, I'd argue that for most people, all 8 of these are relevant. And it's like a checklist we have when we meet with clients. We're all looking at different aspects of their financial makeup to look at any one point in time. And you'll see here from the grid, they're all completely interrelated. Okay, so now I'm going to pass over to Robert Smith, portfolio manager here at Compass Private Wealth, to discuss markets.
It's been a tumultuous year, to say the least. There's so many takes, so many snippets that you can take away from this year and last and into 2023. That will be our focus of our discussion, but I'll touch on some of the main summary highlights and then I'll go into far more detail on each. Obviously, one of the key ones is the Russian-Ukraine conflict. It's dominated the news. Less so recently, but definitely in the last 2 or 3 weeks, we've also seen that the conflict's been at its most intense in terms of bombing, and the Ukraine, apologies, and Russia have been attacking their energy infrastructure. So that's been something that's of great concern globally and on a humanitarian basis. Both bonds and equities, of course, have sold off significantly over the period. I think equities are somewhere hovering down between the 10 and 20% range this year at the moment. Bonds also, it's odd that both bonds and equities would be performing poorly at the same time. That's not normally the case, but it is at the moment. Inflation, of course, is such a topical issue. It's one of the main topics of discussion at the moment in our local economy and the global economy. It's running incredibly hot across all nations. And it's something that we've seen cool recently in the last 2 or 3 months. It's dropped about somewhere in the 10–15% range. But that doesn't mean that into 2023, we won't see it remain steady, but there is a decline. And that's what we're seeing at the moment, which is positive news as a cause of central bank, as the next point states, interest rate increases to cool that actual inflation. We've seen this UK actually is trending somewhere in the 3% range in terms of interest rates. In the ECB, it's 2%. In the US, it's somewhere in the 4.75 to 5% range. And they've been a steady set of increases this year, particularly in the last 6 months, although the general analytical view is that that's going to cool to 0.5% increases, possibly 1/4% increases as we head into 2023. And of course, one of the onset issues that we face at the moment and we're currently experiencing across the globe and in Ireland is stagflation. It's definitely a huge risk for us over the medium term, especially when you see what its impact is. It's very similar to deflation, but it's where basically the growth of an economy is lower than the inflation rate. And at the moment in Ireland, we're looking at in the 9.2% range when it should be in the 2–3% range. So you can see where the that issue arises. So if we look at a market update in terms of asset classes, we'll just go into more in detail. First is interest rates. The central banks have basically been trying to increase rates rapidly over the last 6 to 12 months to cool inflation in the economy. And that has worked. We've seen it work in the UK. We've seen it work in the US, who's ahead of other economies. And we're beginning to feel the impacts of that in global markets too, as investors are a little bit tepid at the moment about entering the market, but they are slowly entering back in. In terms of bonds, obviously, yields have risen. So bond prices, the yields are inversely correlated to the price of the bonds. So when yields are high, which they are at the moment, the price of bonds are lower. So that's a good entry point for someone who's entering a bond. But for those in bonds trying to sell on the secondary market, they might be selling at a loss. So there's definitely an increase in bond prices, and bonds have been highly out of favor this year as well. A 45-year low at the moment in terms of actually bond appetite and bond prices. So that's historical on many levels. We haven't seen bond prices as low since 1994. Just to give you an idea of the impact on bond prices at the moment and the way the economy is. So we're nearly at a 30-year low on bond prices globally. In terms of equity markets, of course, as I discussed earlier, we've seen unprecedented volatility. We're officially in a bear market globally. A bear market is technically basically confirmed as a 20% fall from peak to trough in most markets this year. And we've seen that across the board. There really is no safe haven, unfortunately, in equities. They're the aspects of a portfolio that give the most growth, but they're also the first thing to turn downwards when there's an economic downturn globally. And deposit rates is a very interesting one too. You would have seen that the ECB has increased interest rates On the 27th of July this year, they started their interest rate increases at 0.5%, and yet savers haven't seen that yet. So Irish depositors are yet to see that. We do believe in the first quarter of 2023, you will begin to see that. Across the EU, we're beginning to see an increase in deposit interest rates, but not in Ireland as yet. But we do expect that eventually something has to give here, and we will start to see some interest bearing for Irish depositors. In terms of a focus on inflation, just looking at our local level here at the moment. So the national rate of inflation, as you can see there, it dropped for a period in September. Just year to date, you can see where we started off in the 5% range back in October 2021, and then it increased again at 9.2% there just in October. So it's very unpredictable. We don't know where inflation is going to go, but again, the ECB with increasing rates, the whole aim of that purpose is to lower the rate of inflation across the EU. So we do believe it will come down. It's steady at the moment, but as you can see, it's 4 times the multiple of what it should be. It should be in the 2% range, ideally. We'll just move on to the next slide. Overall, as you can see, there is a general cooling. So in terms of the focus on inflation, if we look at the CPI basket, the Consumer Price Index, you can see who the main culprit is. Definitely, we feel it here is energy. That's one of the standout sectors there. You can see the all items at the bottom is quite alarming. It's somewhere in the 9% range, but that's just a culmination of the above sectors. Definitely restaurants and hotels, you'll have seen prices increase. Transport too. I know that bus fares, trains, bus fares are down, but train fares, flights, if you're taking flights, you'll have seen that they've increased exponentially in price, but particularly in the area of utilities, anything in energy, gas, fuel, water, you will have seen a huge leap in the cost of those goods, and food as well. So the Irish economy is definitely feeling the brunt of that. And yet we'll move on to unemployment at the moment, but you can see we're at 8.7% as of October in terms of the jump. If we look at currencies as well, we just move across to the euro versus dollar currency over the last 5 years. You can see that it's been quite steady since 2018. We've been hovering around the 1.1% mark, but just as of beginning of 2021, the US dollar became particularly stronger. That is, of course, the reserve currency for the world. The US dollar is very strong. The US economy is very strong in terms of unemployment at the moment, which is driving dollar strength. And of course, Federal Reserve interest rate increases is driving dollar strength. So the dollar is almost in parity with the euro at the moment, just hovering in the 1.03% mark. And that's, of course, fueled by a strong US economy and strong US sentiment. Just following on in terms of the euro versus the sterling over the last 5 years, it's been a case of somewhat of steady as she goes. We're in at 0.86%. But you can see the sterling in terms of UK economy has gone through a huge reign of volatility in terms of inflation, in terms of economic outlook for them, in terms of GDP growth. We're in the 3% range at the moment. Next year is projected to be 0.2%. 2024 is projected to be 1%. If you relate that back to the Irish economy, in the Irish economy at the moment, we're due to end the year somewhere in the region of 7.9% in terms of inflation. And if you look at our GDP for next year, we're still hovering in the 3 to 4% range versus the UK. But the price spike volatility, as you can see there, on the 10th of October, there was a mini budget by Liz Truss, the outgoing Prime Minister at the time, and that caused a huge spike. Now, you can't see it on that chart, but it was a one-day spike, just the result of a small mini budget in the UK. Globally, not the biggest impact in terms of actual a leader in economic shifts, but the global market reacted very poorly to that. And obviously, we know what happened in the end in terms of a new Prime Minister, a new Chancellor of the Exchequer coming in. If we look at market sentiment, moving on, just looking forward into 2023, we obviously have people who are bullish and people who are bearish. Those who are bullish are those who are optimistic about the outlook of the economy, and those who are bearish means that they are pessimistic and they're somewhat cautious or quite cautious about what 2023 looks like. So we'll have a look at that in greater detail in a moment. So is 2023 looking more positive? Well, we have the yeses, which is the bulls on our left, and we have the no's, which is the bears on our right. So if we look at the yeses first, in terms of government bonds, are they better value? Definitely they are. The price entry into a bond is much lower. So they're also known as fixed income assets. So government bonds are great at the moment. They are producing a return, yields are higher. So it seems like a very good investment choice for many investors. Maybe people will want to be increasing their bond exposure. So that's the yeses. Unemployment data is strong. If we look at Ireland at the moment, we have 4.3% unemployment. If we look at the US, we have 3.6% unemployment. If we look at the UK, we have 3.7% unemployment. So unemployment is low and steady, and that's driving the yeses. We look at property yields as well. They remain very strong at the moment. So they're very buoyant and they're stable despite what's happening around us. And of course, inflation is potentially cooling globally. We're down 10% approximately from our peak earlier in the summer. If we move over to the nose, the bears, of course, they will say that equities remain uncertain, which is very true. Equities do remain uncertain going into the next 2 quarters, particularly in Q1 and Q2 of 2023. Property rental caps at 2% is still an issue for those who own investment properties, residential properties. Deposit interest is still negligible. We haven't seen that feed through across most of the EU, especially here in Ireland. We're still awaiting for some good deposit rate interest returns, but that will feed through, we believe, in Q1 ourselves here internally. In terms of geopolitical risks globally, they're very fractious. We can see there's a lot of contention between China, between the US. There's a lot of obviously conflict across the EU with Russia, Russia's invasion of the Ukraine. Finland and Poland as well are very cautious. You would have seen they erected a 212-mile fence between their countries. So fears of an invasion into other countries are still very much at the fore. And you can see obviously issues between currency rates and relationships between countries across the EU here locally is still very much uncertain as we look into the next 2 quarters and into 2023. I'll just pass you back to Jonathan now to discuss financial protection.
Thank you very much, Robert, for that insightful presentation on economic and market updates. Next, I'm going to speak about financial protection. And this is an area that, as I said earlier, in positive economic times, people don't think about as much. And I do think it is very important to consider in this present time. So starting off, the first type of risk out there is asset allocation or risks to your capital. So the first obvious risk is that you have too much invested, that you're too high risk relative to what your risk appetite is. So if too large a portion of your assets are invested in equities or property or your own business or whatever it is, you might be taking on too much risk. So that's the first obvious risk out there. And in the event of a downturn, you're disproportionately affected because too much of your capital is invested. The second thing is that some people are too exposed to any one asset class or sector or particular company. So that might be a particular bias that somebody has to say, I only believe in UK equities, or I only believe in the US stock market, or I only believe in putting all my money or keeping all my money in a company I work for in private equity or property or whatever it is. So that's always going to be a risk, because then you're putting all your eggs into that basket of that particular sector or asset class or whatever it might be. So that's very important to kind of step back and look at the big picture and say, there's a great expression that says everybody's baby is the cutest. So what that means is that sometimes people lead with their heart and they're emotionally attached to a particular company. So the best example is somebody says, I want to buy shares in AIB, and they're basing that decision off the positive or the particular experience they had with the AIB branch that's closest to them. Whereas we're always trying to educate people to step away from that and think big picture. And yes, you might believe that this particular sector or this particular company or asset class is going to be very profitable for you, but you have to have limits on how much you allocate to any particular one investment. And the other risk, which people often don't think of, is that you've got too little invested. So if you're too conservative and there's too high a portion of your capital in cash, for example, then you don't have enough market participation, and that is a risk, because if we're currently at 9.2% inflation as of October 2022, and ultimately since February or so of last year, when inflation started kicking into Ireland, prices have increased by, at this stage, maybe 18%. So one could argue that the value of cash has fallen by 18% over the last 20 months or so. So you need to be mindful of that as well. The next type of risk is cash flow risk. And one thing is that if you're working and you're getting up every morning and you're going to work, there's a risk that you get sick and you're unable to get up in the morning and go to work. And that's what income protection is for. That's only for earned income, like for employment income. If you're retired, it's irrelevant. But earned income ceasing is a big financial risk out there for people. The next one is very simple. Your outgoings are too high. And often that happens when people are a bit disorganized and they don't keep a household budget and they just get into the habit of spending. And sometimes there's a way of justifying spending at different times. There's nothing wrong with spending 100,000 a year if you're making 200,000 a year, if you know what I mean. So you need to make sure that your outgoings are in line with your budget, are in line and commensurate with your overall financial situation. Liquidity risk, that's something that's become very important because you could have someone who's got a big property or big home, and the home is valued at 2 million, say, and outside of that, they've got very little. On paper, their estate is quite significant, but actually they don't have the cash flow to enjoy their life or to spend or to help out the kids or to go on a holiday, whatever it might be. So ensuring that you have liquidity, and that's why we would always say that if you're investing money personally, you should always do it in a structure whereby if you change your mind in 3 months or 6 months, you can take your money back without penalties. And probably anybody in this call who knows me well would know that I'm a big believer in pensions. And I suppose the only disadvantage to a pension is that if you put money into a pension, it is tied up until retirement. So you just want to make sure that you keep as much liquidity as possible, both as an emergency fund and an opportunity fund. Next one here is longevity risk. And this was thanks to my colleague Zara yesterday. We were sitting on the desks thinking, what other risks can we put in here? And Zara made the point, longevity risk, which means that it's a good risk. You know, it's a good risk. Thankfully, as a society, we're living longer, and people still have it in their head they want to retire at 60 or 65, and that's great. And enjoy the retirement, enjoy the grandkids, enjoy your pastimes, your activities, your trips away, whatever it might be. But there is a likelihood that a couple retiring at 65, if they're in good health, that at least one of them will live to beyond 90. So that's 25 years plus of living and spending. And that is a financial risk. It's a positive life risk, positive life outcome, but it is a financial risk that you've stopped earning too early and you're spending more in your retirement. So the next one is what I call legacy risk. And that is that if you have built up assets in your lifetime and you want to leave assets to the next generation, that you want to make sure they're sufficiently catered for. Now, if you're young and you're earning and you've got future earning ahead of you, then if you die, that's what life insurance is. You know, a bank will force you to take life insurance if you're getting a mortgage on your home, for example. But to the extent that you have people financially dependent on you, like somebody with small kids, it is important to have life insurance in place. If you're over 65 and you're not working anymore, you don't really need life insurance, assuming your financial dependents are your children, say, are financially dependent. The older you are, the less of a need for life insurance. But if you're younger and you're working and you've got children, you definitely do need life insurance. The other one is, frankly, having a mess of an estate. And you can have some people who've worked hard their entire life. They put their head in the sand when it comes to succession planning, had a default will that they never updated. And unfortunately, after they're gone, there's falling outs with children and different things like that. So that is a risk that a lot of our clients see. Other risk is own bias risk. And what that is, that's what I mentioned earlier about, you know, making decisions with your heart rather than your head. You know, having a view that isn't tested and say, I believe this is the way forward, or I don't believe I need life insurance or income protection, or I don't believe that I need a will, or I don't believe all these things. I suppose we would just ask that when you deal with professional advisors like us, that we try to challenge maybe those biases and think big picture the whole time, and always seek professional advice, because there is a risk that you'll get it wrong, or that you're making decisions based on all sorts of biases. It might be what they call recency bias. So you would say, God, this has achieved 20% return in the last year. Therefore, if I hold on to it for the next 3 years, it might have another 3 sets of 20% returns. But oftentimes the opposite can happen the following year. If it's achieved 20%, it's because it's risky. And in a bear market, it might fall by 20% the following year. There's also external risks, like what happens in the global economy, markets, political. And the final risk is that you listen to people like us too much, and you're too worried about your finances, and all you do is budget and save, and you don't spend, and you don't help your kids out, whatever it might be. And then on your deathbed, you're thinking, for God's sake, I've all this capital built up, I've never enjoyed it. What we feel is that you have to enjoy it as well. That's what planning is. It enables you to step back and say, okay, I have done well. I do have assets built up. I do have a cash flow surplus. I can actually spend a bit more on this holiday or that holiday or whatever it might be. So how do you mitigate these risks? Okay, so the first one is the asset allocation risks. If you remember, diversification, think holistically, think big picture at everything. Be disciplined, okay? You will never see Compass Private Wealth coming to clients with a brochure for a product that we launched to say, you have to invest this by Friday, otherwise you miss the boat. Don't ever do anything like that, invest in anything like that. Be disciplined, look holistically, always invest in regulated and liquid investments. Why would you lock money up into something that you don't understand? Why have concentrated stock positions unless you have to? Now, if you are working for a big PLC and you get stock compensation, all that type of thing, and there's tax implications if you sell, fair enough. There's nothing you can do about it. But other than that, I don't see the point in having concentrated stock positions unless you have to. Always phase into the market, and phase out of the market to mitigate timing risk. And compartmentalize capital. So if you're conservative and you say, I want to keep everything in cash, well, sometimes we do exercises and we say, okay, well, actually, this portion of your capital, which more often than not is your pension, we'll say, well, that actually, you don't need to touch that until you're 75, and you're only 55 now. So you actually have a 20-year time horizon with that portion of it. So why not take proportionally more risk with that portion of your capital and then leave everything else conservative? And what you're doing is you're mitigating inflation risk in that case. How do you mitigate cash flow risk? Income protection, to me, is extremely important for somebody who has future earned income due to them, who's high intellectual capital, who's got a decent income at the moment and wants to protect that income. Hopefully it's something you never need to claim, but income protection is very important. Regular budgeting, which we'll talk about in the cash flow section. Be mindful of unnecessary debt, because debt comes with interest repayments. Debt isn't cheap anymore because of interest rates. So try to avoid unnecessary debt. Really, debt or mortgage on your home, I'm not sure, do you need much else debt ever? The obvious one is live within your means. We can all get caught up in a bit of euphoria and different events and different things on Christmas time and all these different things. But you also really, everybody on this call should sit down, be it with a pen and paper, old school, be it with a spreadsheet. We can send you on the outgoing spreadsheet template that we find useful, which our clients benefit from. But you should have a fair idea for 2023 what your net income is and what your outgoings are going to be. I would guarantee you it would be a positive experience if you spent an hour or 2 hours just putting in place a rough annual budget for 2023. Doesn't matter if you're a huge portfolio or a small portfolio, it's extremely important. We'll talk about that a bit more in the cash flow section. A lot of people obviously love their kids. We all do. If they have children, we all love our kids, all that, our financial dependence. and love giving money on. But remember, you need to make sure that you have enough capital for your lifetime, first and foremost, before you pass it on to somebody else. Building a pension, if you're still working, absolutely important. And the government incentivise you by giving a 40% tax relief to boost your contributions in. How do you mitigate legacy risk? Always have life insurance in place if you're still working. If you're below the age of 65, it's not that important, not as important after that age. Always have a will in place. Compass doesn't advise on, we can't write a will for you, but we'd always suggest to go into your solicitor and have a will in place, and be mindful of certain things as well, that if there's particular wishes that you have, that's recorded, but always certainly have a will in place. If you're over the age of 70, we'd suggest always have an enduring power of attorney in place. All that does is that if something happens to your mental capacity and you're unable to make financial decisions, that you've got a power of attorney appointed who can assist in that regard, so that assets aren't frozen as such. I would suggest, like, every family is different, but trying to, if there is going to be a legacy and inheritance passed on, you have to be proactive with it, and that would be discussing it with children or beneficiaries. Have executors decided. A lot of people choose executors who might be a sibling, for example, when they're in their 40s or 50s or even 60s, but then you're in your 70s and your older sibling is 5 years older than you, and they're your executor, and it might be time to replace them then, because by the time they're needed, they might be too old at that stage or mightn't be around anymore. Carry out as much planning as possible, obviously. Then the last three risks, to get rid of bias risk, you need to take expert advice. That's where we come in. We would always try to challenge our clients in terms of if we disagree with what their beliefs might be. Understand what you can or can't control. A lot of people talk to us about, change of government or in Ireland or what's going to happen here or there. But if it's out of your control and there's nothing you can do about it, you're probably just wasting energy being concerned about it. And look, enjoy your life. If you've got this budget done up and you're comfortable with your financial, with your asset allocation, your investment strategy, then enjoy it. Like, enjoy your spending and don't underspend. We see as many people underspending as there are overspending. So just in terms of financial protection, always it's worth checking what you already have. If you are in your 50s and 60s and you have life insurance in place, always check, does it have a conversion option? Can you convert it without undergoing a medical? You might wish to extend it to 75 or 80, whatever it is. And then look at ultimately how much insurance you need. The more financial dependence you have, the more cover is needed. The higher your future earning potential, the more cover is needed. And generally, the older you are, the need for protection reduces massively. Okay, I'll pass back to Robert now to speak about investing and portfolio management.
Thanks, Jonathan. It was very insightful, definitely. In terms of asset classes, I suppose we'll just move here into the terms of what is the least worst option. There really are 6 main asset classes in which capital can be parked or allocated, as you can see. Although there's many sub-variations of each asset class, they are the key 6. So with cash, obviously, you can keep your money with on-post. It's a preservation of nominal capital if you did. Cash is one of the keys. Bonds, of course, we discussed government or corporate bonds. It could be direct or collective bonds. And they're becoming far more in favor at the moment with rising yields, obviously, and low bond entry prices. Equities and shares, also known as growth stocks or growth investments. That's where you're going to gain most of your investment return, typically in an investment portfolio. The fourth is property, whether that be residential or commercial, active or passive. The fifth being private equity, that's possibly mainly attributed to owners of businesses themselves or those directly investing in a private equity share dealing, let's say for a non-stock listed company. And alternatives. Alternatives are anything outside of that asset class, whether it be oil and gas, whether it be gold, whether it be certain precious metals, or more flavorful investments like cryptocurrencies and things of that nature. It's very important to point out, though, that at the moment there really is, and I think we touched on this earlier, and Jonathan did as well, there's really no-brainer investment, which is very odd in this current investment environment, because normally you would have inverse correlations between certain asset classes. Typically, when equities are low, when equities are performing poorly, bonds are performing well, and when bonds are performing poorly, equities are performing well. At the moment, neither are performing well, although we are beginning to see shoots of optimism in the bond market heading into 2023. And obviously, the second point is that in terms of investment strategy, key principles for 2023, I'll move on. In terms of diversification, it's really important to spread your risk. I don't think there's ever been a time where that's been more potent than now. Sometimes in buoyant economies, when everything's stable, you see diversification as being prudent, and it always is, of course, but particularly in economic cycles like this, diversification has actually proven itself and proven its value, I think, over and over and over again in the last 6 to 12 months. It's very important to have a holistic view of all of your assets, not to just focus in on one of your assets, although you may have a particular liking for a specific asset class or part of your portfolio. It could only make up 10% of your overall portfolio. It's very important to have transparency in terms of obviously understanding your investments yourself. It's very important that you inquire and understand what you are actually invested in. And inertia is a very important one, not to fall into an inertia trap of basically not making changes, or a fear of change, a fear of actually stepping out of a certain asset class because you have a certain bias towards that. That could lead to a lost investment opportunity, perhaps, or just overlooking certain aspects of where there's growth for you on a personal level. If we look at point 5 and 6, it's very important, obviously, that you have a clear mandate and that you ensure that your advisors are clear as to what your risks and objectives are. It's very important that you yourself understand your own biases, your own risk tolerance, and that you know what your objectives are for yourself. Everyone's objectives are individual. We have certain objectives which are the same, but we all have individual goals, maybe set timeframes and time horizons to reach those goals as well. So it's very important that you understand your own mandate and that you are clear on what your mandate is for you and your family. And obviously, conflicts of interest. It is very important to trust your financial advisor. They do have the best interest for you in heart, particularly when they're independent, not tied to anyone like ourselves. So we don't actually have a bias towards a certain provider, a certain investment house. We actually look across the market broadly, and we actually will take the best interests of our clients first when choosing certain investments for our clients. So if we look at why invest, why would you invest in terms of an investment strategy? There's many reasons why a person would invest. One of the most obvious is to generate growth in capital in excess of the risk-free rate of return, more than you can get on deposit with a bank, for example, if you're looking to get an increase in interest in that sense. The second point is to avoid the real value of your money being eroded due to inflation. Unfortunately, a lot of savers and those who have high levels of cash at the moment are seeing that at the forefront, and that's something that we emphasize to diversify yourself away from, or at least have a certain percentage in cash, but have the majority invested where there's growth. Although there is various case studies for holding cash at certain times. The second is to obviously fund, the third is to fund for your retirement years, which is very straightforward. The fourth reason is as a succession plan for the next generation. I know Jonathan touched on that previously and went into more detail on that, and will do. As it's very important for succession planning why you would invest your capital. You're looking after those who come after you. And why should you not invest? What reasons would you not invest for? I know that might seem quite counterintuitive, but why would you not invest? Well, if your financial circumstances or personal preferences mean that you have a very low tolerance for risk, an appetite for risk, or a capacity for risk. In those instances, if you have one or all three, it can actually be decapitating in some places. You might actually find that you actually don't want to act, and that's inertia too, a fear of acting, a fear of investing. That's why you may not want to invest. And finally, if you do not have a medium to long-term investment time horizon, that's absolutely critical. As you can see at the moment, and I'll discuss in later slides, you'll actually see that if you have a short-term time horizon, volatility is far greater, and then we'll see the benefits of having a medium to long-term time horizon. I have a graph on that I'll show you in a moment. In terms of the inflation outlook for 2023, there's two sides to look at it, those who are most negatively impacted and those who are not so much. So we'll have a look at the most negatively impacted first. It's those who basically have an over allocation of cash in a high inflation, low deposit rate environment over the long term. So those who are overly allocated in cash are obviously feeling that from an inflation standpoint, at present being 4 times the average. Where outgoings are increasing at a rate that is higher than inflation, definitely you will will be in a terrible situation in terms of inflation. In terms of owners of residential property with the rental caps, inflation in 2023, that's going to impact upon owners of residential property. Those who put too much capital at risk to catch inflation are disproportionately negatively impacted in bear markets. So depending on where you allocate your actual capital, you could be caught by catch inflation, which we have seen in the last 12 months and is projected to occur in the next, let's say, 1 to 2 quarters of 2023, at least based on analyst expectations. And those who have fixed incomes, for example, in defined benefit pensions that are not linked to inflation, you're actually seeing your defined benefit being eroded away, albeit at a smaller rate, but it's still a rate of erosion. So those who have not been as badly impacted of inflation in 2023, those who have nominal debt that gets eroded away by inflation in inflationary times itself. So that's actually the positive of having nominal debt. Borrowers on long-term fixed rates that are locked in at lower rates in a rising inflationary environment. You think of those who perhaps got in recently on housing interest rates with banks. Let's say for fixed terms, 3 or 5 years, they would have got in at the 2 or 3% range. And we saw in the last month or two, interest rates on houses have increased dramatically. That's just one example. Employment income that goes up in line with inflation income is great. If your employment income is indexed in line with inflation, won't be as bad for you. Passive income that keeps up with inflation itself. So that could be passive income from investments, whether it be residential property, it could be dividends, it could be from a number of means. And those who could easily cut back on their outgoings. So someone who's in a position where they don't have certain tied obligations and they can actually just scale back their own personal outgoings, they won't be as adversely impacted by inflation in 2023. So if we look at the investment strategy for diversification, this is something that's very dear to me. I believe very firmly in diversification. Obviously, there are various investment strategies that can split or diversify. You can be diversified in terms of your asset class. We went through those previously, the asset classes, the 6. Geographical split, just spreading yourself across certain geographies. We're hearing good reports about emerging markets. The US remains strong as we head into 2023-24. GDP growth is still predicted there to be 5.6% in both of those years. If we look at investment type, spread across investment types, not being overly concentrated in one particular financial product or financial instrument as they're known, and custodian provider risk, not having all of your investments with one singular provider or fund house. Sectoral risk, we've seen that in the tech sector this year. Again, that's the high end of the growth stocks. They've sold off dramatically in 2022. So if you had all of your funds in the tech sector only and not spread in different sectors, you would have been adversely impacted over other investors. Having liquid and illiquid investments too. Liquid being obviously equities that trade daily, and illiquid maybe something tied up in property or an overexposure to property, and then growth and income focused as well, different types of investment strategies that focus on growth or focus on income. So why diversity? Why diversify your exposure? As we discussed before, for overall risk reduction, it's incredibly important. And then for more smoothened out returns, for less volatility in your portfolio and more predictability in your portfolio, as much as we can predict returns. So if we navigate the current market environment in 2023, this is a slide and an issue not many people want to discuss. How do we navigate that environment? What does 2023 look like? If we look at the headwinds for navigating, these are really the core 6 that I picked out. Interest rates is obviously one of the most topical issues. Central banks across the globe, particular focus obviously on the US and the ECB, are increasing interest rates, albeit it's predicted from December onwards. I think they meet on the 17th of December, the ECB. It's going to be at a slower rate, it's believed at the moment. Analysts are predicting a 0.5% increase instead of 0.75 that we've seen, although they are still increases. So it's very important to factor in that the interest rates are continuing to rise, albeit we believe they will plateau in 2023 and start to decline, perhaps from H2, from the second half of the year onwards. If we look at equity market volatility, of course, is an issue. Domestic political situations here, we may have a change of government coming up. We're unsure of that. The Russia-Ukraine conflict is continuing to rattle the rest of Europe and the global economy. It hasn't gone away, even if it's being underreported. There's a global recession most likely going to take place. There's a consensus that that's the belief across the globe, that we will see a global recession. It's more likely than not. Particularly at the moment, we're seeing early shoots of that in Germany and in the UK. The Bank of England came out there at the end of October and said that they believe that the UK is currently in a recession and also will remain in a recession for 2023 and 24, just across the water from us. At the moment, Ireland isn't in a recession, and we have good GDP forecasts, and it's quite buoyant at the moment, but we will see how that looks as we head into 2023, although GDP is predicted to half in 2023 for Ireland, from 7.9% to 3.2%. So the headwinds are certainly there and undeniable, and of course unforeseen headwinds which could take place. So as I discussed earlier in previous slides, here's an excellent slide from JP Morgan as the source, which is the time and diversification and volatility of returns graph. So as you can see, long-term investors do get rewarded, and diversification helps to reduce risk. We just took 100,000 euros being invested over a 20-year period. What does that look like? So we see stocks, we see bonds, and we see a 50-50 portfolio. As you can see on a 1-year rolling basis below, volatility remains very high in stocks and bonds. And as we move into the 5-year, 10-year, and 20-year rolling period, that volatility just sweeps away. And you can see the long-term investors are rewarded as they begin to see less volatility and more predictability in their investments. That's over any 20-year period. And in terms of cash flow planning now, I'll just pass you back to Jonathan.
Thank you very much, Robert. And as I may have mentioned earlier, we'll be sending these slides out afterwards. So you might have more time to look through the intricacies of the detail of the slides. This is the last section. I could probably do a full session on this, but we'll just wrap up over the next 10 minutes just in this cash flow planning section. So knowing your cash flow position is extremely important. Okay, so as I said earlier, everybody should sit down and do that exercise. So you need to sit down to look at all of your current income and outgoings and predict your cash flow, definitely for 2023 and preferably over kind of a 5-year basis. Obviously, the longer you're predicting, the less accurate it's likely to be, but it is still very important to also consider one-off changes to your cash flow position. So you look at your cash flow, and then if there's any particular single outgoings or income, to also factor that in. Now, there's certain things, like if somebody said to me, I'm allocating 50 grand to buy a car, or we're doing a new kitchen, or whatever it might be, I would strip one-off items like that off the cash flow budget and just take that off your capital as such. So when you look at cash flow, look at the annual recurring outgoings or incomes, or whatever it might be. So the first thing is that totting up your income is actually quite easy, because we all know pretty much what we earn or what earned income or passive income comes in. The outgoings is the difficult part. Once you have a figure, it's very simple. You're running a cash flow surplus if your net income is greater than your outgoings, and you're running a deficit if your outgoings are greater than your income. So it's so important to have this. There's 4 aspects to financial planning. There's 2 aspects, and they've got 2 subsections each. You've got your capital and your cash flow. Within capital, you've got assets and liabilities. Within cash flow, you've income and outgoings. Now, of those 4, I would say that when we sit down with clients, they pretty much know the assets. They pretty much know the liabilities. They nearly always know the income, and the outgoings is that one determinant that they don't actually know generally. So that's why we always encourage people to focus on that when they're doing an exercise. There's something called the 40-20-30 rule that says that the first 50% of your outgoings should go on essentials, the next 20% on savings and investments, and then the rump of the 30% goes on discretionary spending. The key point here is that the 20% you're putting into savings and investments, if you put the discretionary spending before that, then you won't put money into your pension or put money aside for savings or for the kids, whatever it might be. So it's just putting that order in place. So when you are going to do your outgoings exercise, you need to look at all your expenses and categorize them as, are they essentials? Okay, so we pretty much know what the essential outgoings are: running the house, transport, mortgage, whatever else it might be. Then you look at discretionary spending. So what are you currently spending that's discretionary to you or your spouse or your family? But there's this other one that you may or may not decide, and that's non-essential discretionary. Or you could also say non-discretionary essentials. And that's something that's between essential and discretionary. Some people just like to go essential discretionary, and other times you can put in a third option as well. The key point here, folks, is that what's essential for me may not be essential for Robert, may not be essential for Zara, or whatever it might be. So you need to understand what is discretionary or essential for you. Now, we have this template spreadsheet. Just ping me afterwards, or any of my colleagues. I will send you on this template spreadsheet. And this is just a made up figure, but this is what the outcome is. It's basically the 6 columns. It's what the outgoing is, the amount either monthly or annual. The third column is you put in 12 if it's monthly, once if it's annual, or 2 if it's twice a year. Gives you total outgoings. There's a drop down menu then to categorize it. And there's also a drop-down menu, whether it's essential or discretionary, or you may wish to put a non-essential discretionary as well. And the outcome is something like this. But what it does show us then is that sometimes, if you have a fairly substantial cash flow surplus, you might say, God, I'm only spending 32% on discretionary. I could easily increase that. And then your 32% could go to 40% or whatever it might be. So sometimes budgeting gives you more flexibility and more spending power. But if it's a case where you're not that financially comfortable, your income has taken a hit, or your income has stayed the same and your outgoings have increased by 20%, then usually you can't really touch the essentials, because you can't not pay your groceries or whatever it might be. But your discretionary, you could say, well, it doesn't make sense that I go on that world cruise, or it doesn't make sense that I go off on holidays here or there, whatever it might be. So it is a really good exercise, and just ping me afterwards and I'll send you on the spreadsheet. Remember that sometimes certain expenses are called outgoings, but actually what they're doing is they're improving your capital position. So the first one here is, somebody would say to me, oh, I'm paying 4,000 a month into my mortgage. And they say that's 48 grand a year of an expense. Well, actually, if you look at that 4,000 a month, 2/3 of that or half that could be principal reduction. And then the other portion could be interest repayments. Depends obviously on your term and the amount and all that. But what we would say is that just look at the interest element of your mortgage. And if you're paying 2.5 grand a month off the principal, that's 30 grand a year that your capital position of your home is improving by. The next one is people are paying in, a couple of grand a month into their pension, whatever it is, and they see that as an expense, or they're putting money into a savings policy. Yes, it's an expense, but in terms of cash flow planning, exclude it from your cash flow, because what you're actually doing is improving your capital position. And we actually encourage people to not have a cash flow surplus. It's actually inefficient to have a large monthly surplus, because your surplus is just sitting in cash. Whereas if you can get that money working for you by either, paying off more debt or increasing your contributions to your pension or savings fund or whatever else it might be, that's what we'd recommend. So I'm going to just give you a quick overview of the rest of the slides. We're nearly out of time. So this is just, we talk a bit about retirement planning as well. So when we send out the slides, you'll see this slide. The next one here is important. It just looks at the time period of income and outgoings, and most expenses or incomes have a time period. Obviously, the obvious one being is that your earned income has a time period. It ceases on retirement. But a lot of outgoings that could be for younger families, childcare, or could be college fees for kids or college fees for grandkids in some cases. But a lot of those outgoings have a finite end time. And also certain outgoings may be arising. Say if you have younger kids, you might say, I want to send them to a fee-paying school or private school. That's going to be a cost that'll hit you once the kid turns 13 or whatever it might be. As I said earlier, strip out the capital element of your outgoings. And that's something that we can help you with when we're doing financial planning. A few other tips here, you can read in your own time. And there's a section here, retirement planning, which we won't go through. So we have time for a couple of questions. So one question here, which came in at the very start actually, is where do you invest cash to earn interest? It's a very good question, and it's very relevant to the current time we're in. the Irish banks haven't passed on deposit rates yet to Irish savers. And the reason why they haven't done that is because there's no competition in the Irish marketplace, mainly because Ulster Bank and KBC have left. So you've really got AIB, Bank of Ireland, PTSB, EBS, which is, and the Post Office. And at the moment, I'd say there will be political pressure in 2023 to get these banks to start improving the deposit rates, but because they don't have to increase the deposit rates, they haven't. Now, if you are to earn interest on deposit, or if you want to earn growth on your capital, then the only way to do that really is to invest it, but you should only invest that money if you've got a 5-year plus time horizon. And this comes back to overall planning, to look at the big picture and say, well, you look at all your assets, list them all out and say, I need to have at least 5 years of outgoings in cash as a safe money, assuming you're retired. So for that money, sometimes you have to grin and bear it and say, well, I'm not earning any interest on it, but there's nothing I can do about it because the banks aren't paying interest. It's disappointing. The alternative is that you invest the money. If you invest that money and you don't have a 5-year time horizon, and if you might need some of that money back in a year or 2 years' time, then you're running a risk that the value of that capital will have dropped. Another question here just on interest rates, where we see them going. Yeah, it's a good question. Robert, you can jump in here as well if you like. What I would say on interest rates is that we're actually seeing a lot of fund managers and economists now talking about the potential for US interest rates to drop in 12 months' time, because the US has been so aggressive at increasing the rates. The rate increases will work. As Robert said, the global economy probably will get into some sort of a technical recession. Central bankers will panic, and then they'll say, okay, we've done enough of the rates. We've brought the US rate right up to say 5%, and next thing there'll be a 0.25% drop, and then potentially 0.5% drop, because the Goldilocks scenario for central banks, the Goldilocks is not too hot, not too cold. They want inflation to be roughly 2.5%, and interest rates to be roughly about 2% as well. We'll take one other question here. The question is just about diversification. How exactly do you diversify? Robert, do you want to take that one?
How do you diversify? Yeah, it's very much, well, I suppose there's general ways in which to diversify. Some may say the perfect portfolio is 60% equities, 40% bonds, for example, but you should have exposure. That's just a traditional vanilla diversification, but you should also have assets in cash. You may have some property exposure. You should, as we touched on previously, have geographical, sectoral exposure as well. I would say because 2/3 of the global stock market is invested in the US, there should be a US bias or a US lean towards your equity exposure. And there's various means at which you can actually diversify your portfolio too. I know, Jonathan, you'd have a number of opinions on that, but you'd like to add anything to those comments?
Yeah, I mean, that's really it. I think for us, it's disciplining our clients to not have any particular biases. And if everybody here just visualize a pie chart with lots of different colors on it, and you take that and you look at it from the perspective of asset class, sector, geography, so there's no reason in this day of technology why anybody here who lives in Ireland should be overexposed to Irish shares, for example. The other one is that to make sure that your custodian, that you don't have too much with any one manager, because the one thing we've seen with Brexit and with the portability of financial firms is that they can just leave Ireland. There's different individuals leave one firm and move to another. There's all sorts of things can happen. So we always suggest that your assets are also diversified across institutions. Folks, thank you very much. It's coming right up at 11 o'clock. We've hit the nail on the head on the timing. Thank you very much. Have a lovely Christmas. Do follow up with myself or Robert or any of us with any questions you have. Drop me an email if you want us to send you on the budgeting spreadsheet. We'll send the recording and the slides out afterwards. Compass are very much open for business. We love welcoming new clients. If you know anybody else who'd love to start attending these webinars or meet with any of us, we'd be delighted with any introductions also.
Thank you. care.